So first of all, let's discuss what an adjustable rate mortgage is.
All right.
So we know that when you get a mortgage, or most people know, that you can have the payment amortized over 30 years or amortized over 15 years, or in some cases amortized over 10 years. And a fixed rate mortgage means the interest rate is fixed for the entire term. So if you get a 30-year mortgage, it means your interest rate cannot change over the 30 years.
Right.
An adjustable rate mortgage should be a way to save a little money because you're taking a little risk. Fixes the rate for 3 years, 5 years, 7 years, or 10 years. Some lenders don't offer a 3-year option,
Right.
but 3, 5, 7, and 10. And so the rate has an introductory rate for those 3, 5, 7, or 10 years, and the rate stays fixed for the 3, 5, 7, or 10. And then after that initial fixed rate period, then it turns into an adjustable rate mortgage, meaning the rate will go up and down based on some index, whatever index that is specified in the mortgage. So if interest rates go up a point, your mortgage goes up a point. If interest rates go down a point, your mortgage interest rate goes down a point.
Now, and I believe that's every 6 months, right? So it doesn't adjust monthly. It will adjust and stay that way for 6 months and readjust.
Yeah, so I think it's probably more common for it to be 1 year, adjust every single year. And so what they will typically do, Tammie, is they will say that the rate can adjust no more than X percent in a year. So it can't go up any more than 1 or 2% in a year. And then it'll also give a maximum that it can go up. So it'll say over the life of the loan, it can't go up any more than 5, 6, 7. I'm just making the numbers up. I don't know what they are. So I decided that as I move forward buying a house, that I would like to get an adjustable rate mortgage. I'd like to get an ARM. And really, I would have liked to have gotten a 3-year ARM. But the quote I received on a 30-year fix was, let's just say 6.25. And the quote I received on a 3-year ARM, which I don't think there was a 3, but maybe it was a 5, and I apologize for not remembering, was like almost a point higher than that. I was absolutely floored when I saw that, and I didn't understand how that could even be possible. Now, you immediately started doing some research in Dallas. And what did you find in Dallas when you researched the same topic?
Pretty much the opposite. So it was a point lower than the standard 30-year mortgage.
If a fixed 30 in Dallas was 6.25, which is probably about right, then you were more like 5.25,
right,
or 5.375.
Yeah.
So there was a substantial savings. And when you think about it, 1 point in interest can be a big deal. Let's say you have a $400,000 mortgage. That's going to be an additional almost $4,000 a year in interest. So getting a point reduction on a $400,000 or whatever the average mortgage is here in Metro Atlanta, that would be a big, big deal.
Yeah.
But my guess is the reason that in Atlanta that the ARM mortgage rates are higher than the fixed rates is that lenders are uncertain about what might happen to interest rates. And so they're trying to hedge their bets. They're trying to charge enough to make it all worthwhile for them.